The retail automotive industry is complex and multifaceted, and the ability of dealers to make a decent return on their investment is heavily reliant on their ability to closely manage all the moving parts. Over the years, it has become increasingly important to have a clearly articulated business model, one which can serve as a framework for management decision-making and one that can be used to engage management teams. While it is tempting to think that the dealership business model would be the same across the industry, experience has shown that there is great variance in how dealers go about their business. Some dealers elect for a high turnover, low margin strategy, while others choose to focus on fixed operations in order to capitalize on the productivity and efficiency that they're able to generate. Regardless of which direction is chosen, the business model employed becomes a true commercial differentiator and the difference between good dealers and great dealers. Over the past 30 years, Sewells Group has worked closely with dealers and OEMs across Asia Pacific, Middle East and Africa, focusing expressly on enhancing retail performance. We have done this across three primary business pillars, namely competency enhancement, process efficacy, and business management. Our business management solution in particular represents state-of-the-art thinking across the industry, focusing on brand representation and shareholder returns. Combining education, analysis, and application, our approach focuses on capability building and the production of bottom-line business results. A key component of this is a tried and tested business management model, the MRA Performance Model. The Sewells MRA Performance Model is a high-level financial and performance analysis framework, which is used to analyze automotive retail performance and guide strategic decision-making. The model proposes that dealership financial health is measured by returns, or more specifically, return on operating assets. These returns are essentially the product of an organization's ability to produce gross, manage expenses, and turn its assets. The combination of these three key driving factors create what is known as a multiplier effect, generating significant change in the end result by simply making incremental changes to each of these factors. The three key factors, that is, mix, retained, activity, are fueled by a number of enablers, including productivity, customer retention, processes, staff motivation, and culture. The Sewells MRA Performance Model has the ability to identify strengths and weaknesses across the dealership, revealing the impact of strategic decision-making. The first component of this model is mix. The mix in the dealership is represented by the relationship between gross profit and turnover. When we consider the makeup of a dealership, specifically the margins that are available to us from each department, we begin to realize that the extent to which each department contributes determines the total gross profit that we're able to generate. The mix component is evident across all departments and also plays a significant role within each department. By way of an example, the balance of retail, fleet, warranty, and internal work in the service department has a significant bearing on their end result. The second component of our model is the retained factor. Essentially, what we're looking at here is the relationship between gross profit and expenses, or more specifically, the proportion of gross profit that the dealership manages to retain as profit before tax. Dealers who do this well have an ability to tightly manage their expense base through discipline, process management, and productivity. Each department has a responsibility to manage this component and to produce gross profit to cover their operating expenses. In terms of performance, if a dealer produces a gross profit mix of 15%, we would be looking for them to retain at least 20% of this, leaving them with a return on sales of 3%. The final component of the model examines the ability of dealers to generate throughput in relation to the assets that they have employed. Asset management is a crucial consideration for all dealers. The investment required to simply operate the business on a daily basis is substantial, and the disciplines around stock management and control are critical for driving shareholder returns. The measurement of activity looks at a dealer's average operating assets in relation to their annual turnover. Well-run dealerships operate at 6 to 8 turns per annum. Once again, each department has a specific responsibility for driving their own activity, whether it be days stock on hand, receivables, or work in progress. Bear in mind that if a dealer manages to produce 3% return on sales and has an activity of 8 turns, that will result in a 24% return on operating assets. When considered together, the three components of the MRA Performance Model combine to form a multiplier effect, each one leveraging the performance of the next. When combined, the mix, retained and activity factors result in a return on operating assets figure. This is a crucial bottom line number for the dealership management team, one which provides tangible evidence of financial health. In our experience, having a business model is essential to long-term success in automotive retail. The MRA model provides a great framework for dealers looking to take their business to the next level. Its ability to inform the management team and guide their strategic and tactical decision-making is well proven and well worth considering. Looking for more information? We invite you to visit sewellsgroupmra.com or to download the MRA app from the Sewells Group website.